I lost over $200,000 trading iron condors with an 84% win rate. Now, apparently, I'm the one person in the world who lost money with iron condors and the one person in the world who lost with 84% win rates. But that's because my risk and returns were out of sync. I had too much risk for the amount of returns that I could get. But we found this video that says, do this instead of iron condors. Maybe we can learn something together. And maybe we can profit from it. So let's watch this together and learn together.
So those of us that have traded options for any length of time, we know the iron condor nightmare. You spend weeks collecting dollars only to have one bad move wipe out a month's worth of gains in a single afternoon. It's a broken cycle. I lived it for years, but I finally found a way to break it.
That was weird. He kind of like paused for a moment. Maybe he needs a Rudes to come save us. Rudes, come save this guy.
The math on iron condors is deceptive. Sure, they have a 40 to 50% chance of profitability on paper, but when you lose big. The risk.
That's exactly what happened to me. When you lose big, because the risk return, you might make $1 and lose $4, right? And there are other people who would teach you. In fact, let's do the math on this real quick. Hang tight. Need to open up a new spreadsheet. Hold tight. Don't save that. New spreadsheet. All right. So let's say that you could make $1 and risk $4. Okay. So the most you could win is $1. The most you could lose is $4. This is where I lived, right? $5 wide spreads, super out of the money. And that would pretty much be what it would look like. Now, for every one loss, obviously, I needed 4 trades to get back, right? I did that wrong. Equals this divided by negative this. There you go. I needed 4 trades to get back to break even on every one loss. But the people who I learned to trade from, and I'm not going to name names, you can figure it out. Probably not that hard. But so, you know what? To increase your win rate, take half of the credit that you could receive for a maximum. That way you increase your win rates. Duh. And that makes sense, right? Take it off early. But now every one loss would take 8 trades to get back to break even. This was where Chris lived. This is how I had a 84% win rate and still lost $200,000. Is because the risk to return here is broken AF. You can't make money doing this. You cannot mathematically have a positive expectancy doing this. Because for every one loss, you now need 8 perfect trades to get back to break even. Never going to happen. I didn't say it. You said it, right? Those people are definitely some derpy jokers. I didn't say it, right? But when you learn from a derpy joker, you get derpy joker results. I don't want that for you. Oh, you have Batman results.
Risk to reward is just upside down in them. I realized I was okay taking bigger losses occasionally, but only if my win rate was high enough to make the math work. 45% winners wasn't cutting it. I needed a trade that could win 90% or more of the time. So I stopped.
So, okay, that's interesting. He's needed a setup that would win 90+% of the time. That's a hard rule to, or hard road to come by, but maybe he's got something for us. I mean, listen, if he can figure this out and we can apply it, maybe we should apply it right away.
I'm guessing. I took my 30 years of trading experience and I combined it with heavy-duty AI modeling to stress test a completely new trade structure that I call the flyagon. What I'm going to share with you isn't backtesting theory anymore. Since I started trading this live in May of 2025, I've had 129 trades that I've closed out. Of those 129 live trades, I only have 8 losers. That is a 94% win rate over about a 7-month period of time. And purely in terms of capital efficiency,
I mean, I'm interested, but I'm curious if it's going to break the golden rule of trading or the golden rule of leverage, where you put yourself in a situation, never put yourself in a situation where you can lose more than you can make. I'm just saying. You know the old phrase, you can't have your cake and eat it too? I didn't understand that for a long time. I was like, what do you mean have your cake and eat it too? If I have my cake, then I can eat it. What do you mean I can't have my cake and eat it too? Then someone explained to me, and I forget where it was, you can't keep your cake and eat it too. I was like, oh, okay. Now that metaphor makes sense, right? You can't keep a cake on the table, yet put that cake in your belly. You can't do two at the same time. Maybe he's figured this out. I don't know. I'm actually very interested.
It's generated over a 150% return in that same time window. Now let's go to options.
I'm just saying, if it's that good, maybe he should enter the U.S. Investing Championship, because yours truly is going to enter the U.S. Yours truly is entered into the U.S. Investing Championship for 2026. I don't know. Maybe if it's that good, he should do it.
And take an initial look at these two structures. Now I've modeled these in the same expiration cycle and essentially with the same break-evens at expiration. What I want you to specifically notice here is a few key things. First of all, I want to look at the reward to risk ratio in both of these trades. If we look at the iron condor on the left-hand side here.
Okay, let's see if we can make this a little bit bigger. Okay, I know this is really faint. It may not even show very well at all on your screen. But in this example here, he's trading the SPY. Looks like he's doing it with a 10 days to expiration, which that makes me nervous already. Can't really tell what the deltas are with it. Okay, but it looks like he'd taken a credit of 112 with a on a $2 wide spread. So his max loss is 88 cents, which puts you right at, he probably had a 30 delta and a 30 delta, which combines to a 60 delta, which means his chance of profit, quote, probability of profiting is at 43%. Okay, let's keep going, because that's what the iron condor looks like.
We can see that we have a max loss potential of $88 and a max profit potential of 112.
Okay, now first, I will say this does not break the golden rule of leverage. You actually can make more than you can lose in this case. So I like that. However, anytime you see the max profit being greater than max loss, when you're selling options, that generally means that you've like made a very small window of making profit. So let's continue on.
So that's a little over a 1-to-1 ratio, probably about a 1.5-to-1 ratio. I'm risking 88 to make 112. Let's look at the diagonal on the right-hand side. While it does have a little bit more max loss associated with it, the max profit potential is over 4 times the size of the max.
Okay, again, he set this up in a way where max loss is less than max profit, so this doesn't break the golden rule. And then you go over here, max loss of 145, max profit of 530. That definitely doesn't break the golden rule. Now, we talked about this on the last options deep dive, where you can pin certain areas. But when you pin it, right, like let's say that he did 2 iron butterflies here, and I don't know what he did. Of course, we'll continue on. The likelihood of getting these pins is exceptionally low. In fact, I tried one day. I got so close. But the frustrating thing about it, so I live in Central Time. So the market expires at 3 p.m. Central Time. So imagine if this is what your profit and loss curve looks like. Let me draw real quick. Right, let me draw real quick. If this is what your profit and loss curve looks like, okay? The most you can make at any point in time up until the day of expiration is going to be like right here. Like, let's say if this is your 500 max gain per contract, you might get 20, okay? Now, on the day of expiration, it starts getting a little bit higher, a little bit higher, a little bit higher, and a little bit higher up until 3 p.m. Central Time. If it hits this exact point at 3 p.m., that's when you get paid the most. And I remember watching it on the day of expiration, and it was going back and forth right around my strikes that I had pinned this at. And I was like, this is amazing. But I'm watching, right? 8 a.m., $20, 9 a.m., $25, 10 a.m., $30, 11 a.m., $35. And we're trying to get to 500 here, right? 11:30, $50. 12 o'clock, maybe $100. And I'm like, where's my money? Where's my money? Why am I not getting paid? This is like right here. It's going like between X and Y right here, right underneath the pinpoint. And I'm still at like 100 out of 500. And I had to wait until the very last second of the day to get this. And I didn't even get this because you still have to close the trade. Otherwise, you're getting a sign and you have to go through all that crap. I might have got like 450. And I was like, this freaking sucks. I am not into this, right? I have to wait until the very last possible moment of the day. And I just might get this full value. So when I see things like this where they talk about the max profit you can make when you pin it right there, I think that's pretty unrealistic. No offense. I do hope that Option Strat watches this. I think we could do some great collaborations. But like that's a hard sell for me, having lived through that exact experience trying to pin it right there. But let's keep going. Maybe I don't know where I'm at. Where's my money at? Mo money at 3 p.m. Exactly. Show me the money.
Max loss. To me, that's huge. Now, I'm not shooting for that max profit. I want to be clear on that. But the fact that that ratio is there means I'm getting something else in this trade. I'm getting a lot of theta decay. So let's take a look at theta specifically. If I come and I look at my Greeks here in Option Strat, I can see that in the Condor, my theta is about $4.
Now, remember, theta is the value that will decay over time, no matter what. So if you buy the option, that's how much comes out of your account. If you sell the option, that's how much goes into your account. So conceptually, over time, selling options make sense because you do have time ticking past, which gets you the theta. Where it breaks is the delta move, because the delta is going to overwhelm any sort of theta, right? Because if it goes over here, it doesn't matter how much theta you have, you're going to get absolutely monkey hammered to death on your deltas.
A day. If I come over and I look at the diagonal, my theta is over $9 a day, more than double the amount of theta. That's because both of these trades stack on top of each other right around the current market, and theta is decaying rapidly out of both of those. Now, I also have each one of these trades set right now to show the P&L on the trade at 4 days in. What I want you to note here is let's take a look at the break-evens between the two. If I look at the break-evens here on the Condor, our lower break-even here is now at 670, the upper is at 690, so a little under 20 points wide. Let's look at the same break-even.
Hang on, let's do some conceptualization. 20 points on the SPY is how much? Like let's try and eyeball what 20 points on the SPY looks like. No, 20 points on the SPY is pretty good. 20 points on SPX is totally different though. Let's do 690 to 670. I mean, that's a decent profit window, right? That area right there is the profit zone. So it's a decently wide profit window, right? We looked at a similar trade on SPX the other day, and you can see just how itty bitty baby zones those were to actually make any sort of profit. When you compare it to like looking at the price of the price chart here, it just disappears. This one, not so bad, not so bad. I can definitely see some areas of profiting, but let's keep going.
On the diagonal, if I come over to look at the diagonal, we can see that my break-evens go all the way up here to 697. On the lower side here, they are at 673. So significantly wider in the diagonal as well.
Is it though? Hang on. Because it looks to me on this chart that your break even is at 673. Looks to me on this chart it's at 673. Okay. Call me crazy, but that sounds like the same number. Okay, then let's go to the upside. 693. This is 694. Call me crazy, but I think you get $1 extra to the upside to your break even. Am I misreading this? Break evens further to the right? Is it though? Expiration, the dotted line, is what I'm looking at. I know it's going to be really hard to see, but there's a little red line right there, goes up, little green line right there, down, little red line right there. That is your profit window. I know I'm crazy. I know I'm crazy. The blue vertical lines are the break even. Oh, okay. So 673, 690. No, they're not the break even. No, they're not. Because, hang on, let me draw. Let me cook, as the kids would say. This right here, I'll make this easier for you to see, is what an iron condor looks like at expiration. When it crosses this line, that's when you lose monies, right? That value is 674 right here, maybe 673 if you want to push it, and then 693 to the top side. 674, 693. Okay, and then we look over here. The dotted line is your expiration. And so let me draw on this, show you what it looks like. Right? So here's your break even. Is that not the same 693, 694? And then here's your break even. Is that not the same 673? Unless I'm mistaken, and that totally could be the case, I don't see any advantage here. I don't see any advantage here. But maybe I'm wrong. Let's keep going.
So to get to the heart of the flagonal and what it really brings to the table that's unique, I want you to take a look at this Vega number. Your traditional...
Oh, Kasha says blue lines are break even at the point of time. Okay. So break even at 4 days to expiration instead of at expiration. Okay. So at expiration, it makes no difference. Before expiration, you've got, you'll make, hang on. Does anybody see the problem here? So at expiration, we've got the same break-even points. Before expiration, this one goes out and you're going to make 14 cents. This one is the same. So there you go. He could make 14 entire dollars before expiration, I guess is what he's trying to say here. Yeah, note to self. When it comes to options, Chris knows his caca. Well, I think this is important, Vaclav. I think this is an important point to point out. When you sell options, you don't get paid until expiration. You're gonna, and someone's gonna come in the comments, you're gonna be like, no, you don't know what you're talking about. Chris knows his caca. That theta that he's talking about right there, that's what pours into your account on a daily basis, okay? So if the max gain on this, I forget what it was $112, that means per day, he's going to make 4, okay? Give or take. So he's got to have that time work for him. In fact, let's look at what a theta curve looks like just to illustrate the point here some more. Hold tight. I have a slide for this. Here, right? So this is what theta decay looks like, right? It starts slow and it accelerates like bigly right up until expiration. So this is how much you're getting paid daily until right at expiration, like literally the day, 2 days, 3 days before expiration, when all the price comes in, okay? That's because that's the extrinsic value. The extrinsic value, that's all he's trying to get right here. The extrinsic value is going closer and closer and closer to 0 as each day goes by. So the only way you're going to make any money is right at expiration. I mean, you might make a couple pennies here and there, and I suppose that's what he's trying to say, but I don't want to make pennies, I want to make dollars.
Condor is negative Vega. The flagonal is usually neutral to sometimes positive Vega.
And Mr. Knight, the knight who says "nee," I love that. You get paid when you close the position, and you don't get the max gain until expiration. Yes. Yes, exactly. So this dotted line that I showed you earlier, right? That is what it looks like at expiration. This is what it looks like. Hang on, I'm just trying to make sure I understand. So the solid line is 4 days to expiration. The dash line here is, oh, that's in 4 days, and this is in 7 days. Okay. So it's getting bigger. Okay, yes, I'm following now. It's getting bigger as it gets closer to expiration. Yes, for sure. totally understand where he's coming from. And it makes sense, right? Because the closer you get to expiration, the more possibility that you're going to hit that profit curve. And it's the same as on the Iron Condor, right? Imagine this is today, this is a week from now, this is expiration. Okay, we understand. We understand. In fact, let me draw on the chart here. I love this, by the way. I can nerd out on options so hard. I don't know what your thing to nerd out on is, but options are for me and fancy watches. Okay, so imagine the solid line is today. So we're going to mark this line as a T. The solid line is T for today. The dash line is 1 week from now. We'll mark that as a W. And then E is your expiration line. Okay, so the today line, you're going to make a couple pennies. Though a week from now, you're going to make maybe a couple dimes. There you go. Couple pennies, couple dimes. And then at expiration, that's when you make your dollars. Okay. Everybody follow along? Type a number 1 if you're following along. Type a number 2 if this still doesn't make sense yet. Type a number 1 if you get it. 2 if this still doesn't make sense yet. Because the closer it gets to expiration, the more it's going to fit this curve. And the peak that we talked about earlier only happens right at expiration. Okay, I'm totally on board. I think we're all in the right spot. I see tons of ones coming through. Thank you guys for confirming. All right, I'm loving this video. We're learning a lot. Let's keep going.
So what that means is a couple different things. One, to put on an effective condor, a condor that you have a higher percent chance of getting a win out of, you need to wait till volatility is higher to enter it. So you can't just enter them at any time. With the Flyagonal, because it is Vega neutral, many times Vega positive, I don't have to wait for a set of circumstances to enter that trade. I can enter it at any time. Now, another thing that Vega does for me, and this is where it gets critical, is how the trade acts when it gets stressed. So I want to come in and I want to show you.
I think that's a very valid point, right? Somebody said, now talk about the downsides. Yeah, but show the downsides. Exactly. Like, for example, SPY's in a big bullish uptrend right here. If SPY continues and blows out to the upside, right? Remove. You've capped your gains both directions, right? You've basically boxed in your trade, right? You've boxed in your trade and said, don't even think about moving outside that range. But let's say it does, okay? And both of these have that situation, which is what happened to me. It was a constant battle of blowing out one side or the other. A constant battle of that. Let's continue on. I want to see what he says.
What happens if volatility were to decrease or increase in both of these scenarios? So let's come over here first and we'll take a look at our Iron Condor. If our market goes down a little bit, more often than not, when our market goes down, volatility will increase. Let's see what happens to the profitability in that trade. As I slide my slider here, we can see that as volatility increases, even though I'm right centered under that tent, that trade can start to lose money. So again, more often than not, when our markets go down, volatility.
Right, but let's also keep in mind he basically doubled volatility in this example here, and he's looking at a 10-day trade. The idea that volatility can spike extrinsic value by double in the span of 10 days is really unlikely. Really, 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 really unlikely. Right? That's basically taking let's go to the SPY 10-day right here. SPY. By the way, I'm loving this. This is fun. Chris knows his caca. Let's go to December 22nd. That's roughly 10 days. Right. So let's say that you sold the 60 delta, or I'm sure this would be more the 30 delta, wouldn't it? Right. The 238. 238. You're basically saying the price of this option would double while getting closer to expiration. Hear me out. There's some logical fallacies here. The price of the option would double as it gets closer to expiration. That's not going to happen. Can it increase? Yes, because what's baked into extrinsic is your Vega, which is a volatility, but also your Theta. If you took off half the time to expiration, the chance of it doubling from Vega is like unbelievably low. The market would have to crash. And you know what would happen if the market crashed? You know what happened if the market would crash? It would blow through the downside of this. And then you're not worrying about Vega at all because your delta just overwhelmed everything. Okay, but let's continue on because that's not a realistic scenario.
Volatility goes up. So this Iron Condor could be in a world of hurt, even if it's under the tent.
No, I mean, the Iron Condor is going to get absolutely monkey hammered. Oh, and you know what? I feel like I could use this right now. The Iron Condor is going to get monkey hammered, not from the volatility, but from the price going down. It's been a minute since I used that.
If volatility rises. Let's take a look at the same scenario over here on the diagonal. So what I want you to notice is how this diagonal acts over here when volatility goes up.
I'm going to drop chat off a little bit just so we can see his examples.
So if volatility starts to rise, again, our markets are dropping, volatility in.
Okay, so, and this is why I wanted to drop hell off, because I want to watch what he does. So he's taking volatility from 1x and moving the slider to 2x.
Increases. What happens over here? This tent widens.
So basically, he moved it from 1x to 1.5x. So he's saying that the Vega value, what's baked into extrinsic, would increase by 50%. That is what he's measuring right here. But again, if the market totally dumps, none of that matters. None of that matters.
Out. Profitability comes into that side of the trade. This trade can be self-adjusting. It doesn't do it every time, but it is certainly an edge that's built into this trade. The other thing I want you to notice when that happened is, where did our break even go down here? Our break even is much, much further down than it was before.
Okay, now the way that this would work, I'm understanding now. The way that this would work is he's got long options out on the wings, and the long options are gaining value. That's why it's getting further and further on the break even. So the long options where I would be buying, buying options basically, those are what's going up. And that makes sense because the puts, right? If the price of the stock is going down, then the puts are going to be gaining not just extrinsic value, but also intrinsic value if they happen to go in the money. So that's why it's doing that right there.
Or in a volatility spike event. Now, let's take our implied volatility back to where it is, and let's assume the opposite. Let's assume our market goes higher. So our market goes higher. It gets up into this range here. It's going about 50 points higher. What happens on the diagonal? Well, if our market goes higher, more often than not, volatility drops. If volatility drops, where does profitability come in on the trade? It comes in on the butterfly side of the equation. So again, this kind of helps on that side. If we come over here to the Condor, the same is true, but it does not mount up nearly as rapidly. If this starts moving down here, we can see that profitability does come in, but look at where it's centered. We're still centered back here. If our market goes up and volatility drops, I want the peak.
I think obviously this trade is focused in on Vega first, your volatility first, and your Theta second, with Delta being your third priority in this case. But in my opinion, I think you really should, and this is my opinion only, I think you should be focusing in on Delta, because that's what the price of the stock is going to do. That's what the price of the stock is going to do. And it's going to wreck you to one side or the other, even if Vega expands. Theta cannot expand. Theta only goes down. If you get blown out to the upside, you're still going to get blown out to the upside.
To be more up around where my market would ultimately be in that rise in the underlying price. So at the end of the day, with the diagonal, we are not fighting the trend. We're using it in our favor. It will self-adjust to a certain extent. We survive that crash. We profit in the rally. But the real secret weapon is that Theta bomb. That Theta bomb is that center where these two trades cross over. And that's what gives that huge amount of Theta that decays rapidly, which means that I'm out of most of these trades in under 5 days. So less time in market means less exposure to black swan events.
So this goes back to what I was saying way earlier on in the video, which was if you're trying to increase your win rates, you take off your profit well before you ever hit that max profit. So he's never going to hit those spikes. Those spikes that we drew on earlier, like he's already said, I'm never going to hit those. So I don't know. In my opinion, if you want to get fancy with options, you totally can. This is definitely a way to get fancy with options. It's not for me. It's definitely a lot more complex than I want to be working. But listen, if this is for you, let me know in the chat. Like I said, like he said earlier, he's been using this a lot. He's got a 90+% win rate. He's done incredible things in his account, and this could be brilliant for you. For me, it's not so much, and that's okay, right? Everybody's got to develop their own trading style, and that's what we teach at Outlier University. Did somebody just say Outlier University?
Are you ready? Let's go!
Respect is earned. Respect is never given.
All right. So this afternoon and every Tuesday and Thursday, we are having class, and it will be in session with 9 students where we are going through and helping them build their trading plans. Last time we talked about what they can trade, when they can trade, and how much of it that they can trade. This week, today, we're going to be focusing on entries and exits. Now, here's the thing, right? I show constantly my entries and my exits. Does that mean it's the best thing? No. I mean, as this guy proved right here, he's doing exceptionally well by following a completely different system. My goal in Outlier University is not to teach you what I do. My goal in Outlier University is to help you come up with a plan that fits for you. Fits for you. Now, 50% of you are going to listen to the university. You're going to listen passively. It's going to go in one ear out the other. You're not going to learn anything. Not going to make any difference in your life. 25% of you are going to listen, and you're going to half-heartedly implement the processes. You're going to lose your money. You're going to come back and say, Chris made me sell my SoFi shares. And then the other 25% of you are going to listen. You're going to implement what we talk about. You're going to create generational wealth, and you're going to be able to maybe have Masters of the Universe money, maybe even participate in the U.S. Investing Championship like I'm going to be doing in 2026. I'm very excited that I signed up for that. So listen, the choice is yours. You can decide where you fall into. But I want you to be successful. And that is why Outlier University is 100% free, 0 cost. It is lying on YouTube forever. It will be on YouTube and the Outlier University playlist. Why are we doing this? We want you to be successful. And when you're successful, you can become an outlier. That's my evil plan. How about I give you success for free? When you become successful, come be an outlier. That's the plan. An outlier is 82 cents a day. It's unbelievably inexpensive. So if you're ready to save time, make money, start with less risk, click one of those Outlier University videos, and we'll talk soon.